Good day. It's Wednesday, December 8th. I'm Martin Gagel with Market Radius Research. Today, we've got Cameron Watt, CEO of Intouch Insight. Intouch offers a complete portfolio of customer experience management products and services that help global brands better understand their customers' actions and perceptions with its flagship SaaS software offering, LiaCX. Intouch Insight, I've known them for many years. I've always appreciated Cam's upfront style, and while this is a small company, they've got a long track record of growth and prudent business management. This is definitely no pump and dump story. Almost every bricks and mortar retailer has hybrid online-offline strategy, and I think that they need the data from the offline in-store world to supplement their online data to better understand their customers in this super competitive world of omni-channel consumer sales and marketing. And that's where I think Intouch has a good opportunity. But remember, this is neither a recommendation nor investment advice. We're here to learn about the company, do your due diligence, and come to your own investment conclusions. Cam, thanks for joining us, and let's hear your pitch.
Thanks for having me, Martin. Obviously, as mentioned, I'm the president and CEO of Intouch Insight. And with that, I'll click some buttons. And this is the most important slide here. Everyone loves this slide. This is the legal disclaimer. I'll let you all take a screenshot and and read that as you go to bed tonight to put yourself to sleep. But I do have to put it up. So now I did that. So who are we? We were founded actually in 1992. Our roots go back to 1978 through acquisitions. We've been public for more than 20 years. And, the mission statement, as you can see there, is, to create shareholder value by designing, building, and delivering solutions that collect data for customers and provide information that improves business outcomes. And I always pause on that last part. And the reason I put the mission statement in that investor presentation is that, we've seen it, we've proven it, and we'll see some data later that shows it. We have been very resilient through this pandemic, despite serving a lot of people who've struggled. And the fact that our business outcomes, that we help people with those, that's why we've made it through. That's why we've been sticky, is because we're not just shoving data into a pipeline or just throwing data into a spreadsheet for people. We actually have software and tooling and systems, and we actually provide information in a way that they help their own operations improve their delivery of customer service. And that has a value. And we've proven that has value as we've gone through the last couple of years. From the board of directors standpoint, Michael Gaffney is our chairman. Then you've got Eric, David, and Reiner, and then of course myself. Won't talk about them that much, but I'm a CEO, so we all like to talk about ourselves, don't we? I've got a couple of degrees, including an MBA. I've worked for some of the largest companies on the planet, including in management, including Mars, Unilever, Pizza Hut, Frito-Lay. I've also owned my own convenience store. I've owned my own gas station, my own convenience store, my own restaurant, and I've grew up in a number of family-run businesses. So, I've got this very eclectic kind of entrepreneurial, but also massive corporations in my background. And why it's relevant is all of the jobs that I've done have either been in or servicing the same industries that Intouch now services. So I have a pretty good insight into the industries we serve, the customers that we look after, and it helps obviously a lot as you're trying to build a business to really, really, truly know the customer base that you're serving. Now, enough about me, as they say, and we'll move on to the capital structure, something maybe a little more interesting. Now, this slide was done not a couple of days ago, so it's never completely in date. I think we're trading at 72 cents last time I looked this morning, but that's 68 cents Canadian. We only have a 25.1 million float. That's a very tight float, obviously. We have a market cap there for about 17 million Canadian. And our free floating shares are about 16.6 because there's 34% that are insider owned. In that, Eric and I are the largest shareholders. I am actually a little under 10% because of Canadian tax law. I personally hold a lot of it inside tax-free vehicles, and therefore I can't cross that threshold or bad things happen, unfortunately. But I can tell you that I wish I could have bought more during the pandemic because we had some pretty good options, and we still do. I also want to point out that Lisa Van Kesteren is a new name on this chart. She is the owner of the company that we just bought on October 1st. And Lisa is not one of these, people who are just getting out of the industry and exiting and done with the business. She sold because she wanted to see her company grow and do better and do more. And she knew that she didn't have the type of technology and opportunity that Intouch had. And so she selected us to sell to. And part of the deal is, she took a significant ownership position in Intouch. And so that's pretty cool to have somebody, with her experience and her motivation and her desire to grow, but also have her financially tied to our business is a great addition to that insider list, which is why it's at 34% now. And I think that's pretty cool.
No, I'm sorry.
Yeah.
Could you flip back to your cap table there? When's the last time you guys issued 1.5 million shares for Lisa's company recently? When's the last time you actually issued shares in a capital raise?
Well, we've actually only ever done one capital raise since we went public back in around 2002, and that was in the fall of 2017. We did a capital raise in order to accelerate the development of our software, so that we could get our SaaS products out the door and get some more technological advantages, moving on the business intelligence and analytics side. But yeah, and we raised 3.5 million Canadian in the fall of 2017, and that's the only raise we've done. The only other major issuance I can even think of would have been in 2015, when part of the deal to buy StataPex was a $600,000 share grant to the owner of that company. And he, of course, retired, but his daughter is our vice president of operations. So we do have a tendency to hold on to talent when we buy companies.
So your stock has not been rolled back over the last 20 years, which is so typical of so many 20-year-old venture stories. This is just growing organically.
Yeah, we have not. We've not done a lot of issuance. We haven't done a lot of dilution. We also haven't had to roll back stock. So we have, sure, you see a $25 million float, but was it to your question, did it used to be 125 million, right? And no, it isn't. It's actually gone up from 15 million to 25, just as little things have happened here and there, but we haven't done any rollbacks. We basically bootstrapped our own business, from inside. Like our entire software business, all of our technology and our advantages that we actually have in the market right now, which we'll talk about, we bootstrapped them with the exception of that one raise in the fall of 2017.
What happened? Just the pandemic cliff on your share price. There was a rise just ahead of that. What happened to that to sort of get the spike going? And then obviously we know why it went down shortly thereafter.
I've got some slides that'll help with that later.
Okay.
But effectively, things were working. But I'm going to table that question, Martin, because there's a specific slide that's going to actually answer that question. How about that?
Perfect.
Flip it over a little bit to what we do, just kind of understanding the business itself. We really have two main product lines, let's call them. We have recurring services and we have recurring software. When you think about the services, it's mystery shopping, it's overt and compliance auditing. But if you think about what the services are, it's really us going out to locations to find out information on whether people are doing what they're supposed to do or not, regardless of what type of place that is. Brands have to maintain a brand image. They have to maintain a standard of customer service, right? Whether it's a regional brand, a regional restaurant brand with 30 locations, or whether it's a global brand with 3,000 North American locations. It doesn't matter. It doesn't matter if it's franchisee, licensee, or corporate. Everyone needs to maintain their brand and their brand standards. And what we do is we go check on stuff. I'll use a real easy example out of if we're going to a gas station or a convenience store, right? We may go to that convenience store with somebody to check to see and make sure they're not selling alcohol or tobacco to people who are underage and not allowed to buy those products. We may also go to those same locations to find out whether or not their customer service standards are being adhered to, i.e., are people being friendly? Are people wearing their uniforms? Are people suggestive selling? Are people doing the service standards that are applied? How long do people have to wait in line? Those types of things. At the same time, we may go and do much more deep. Yeah.
Sure. Let's say with the cigarettes and alcohol, you would send a young-looking adult into the store. They buy a 6-pack and then see if they get ID'd on it. basically.
Correct. There's actually two types of those programs. One is exactly what you said. We send a young-looking adult. Typically, they have to be below a certain age, young-looking. They go in, and most organizations now, at least most good companies now, organizations have policies like We ID. You see the signs on the till. We ID if you look under 30, right? And they do that because they want their people IDing more people. And so we send in a young-looking person, see if they get ID'd or not. Right. We also have the odd program. I don't recommend these. I think they're a bad idea, but there's some governments, won't name them, they're provincial, that believe this is the way to really check. And it's more like a trap than raising standards. And that is, we will send in a minor, so somebody under the legal age, to try to buy product. And the reason it's not great is when we do that, we also have to send an adult with them who is then outside the store in case they actually get sold that product. The adult then confiscates it when they walk out the door, right? Because obviously we can't be paying somebody to go and collect product that's an underage person. So it winds up being a team of two. So that's a little more awkward, but we do that as well. If that's what's needed. It's not in my opinion, not the preferred way. The preferred way is to send in a young person and have corporate standards where that person should be ID'd even if they are 23.
Yeah, makes sense. All right, thanks.
And from an auditing side, we may, and besides simple things like that, we may also show up and get much more detail. We may show up and check temperatures of coolers. We may check expiry dates on products, right? We may get into some very detailed operational viewpoints on health and safety. In fact, during the pandemic, we flipped a lot of our customer service shops because it's hard to see someone smiling wearing a mask. We flipped a lot of those to be checking to see if there was hand sanitizer available, if there were floor distancing markers, if people were observing the rules around, the COVID at the time. So we can really measure anything, any type of standard inside a location. And the reason, they use us is if it costs a lot of money for the company to send people to 100, 1,000 locations. It's expensive. And whereas we have, tens to hundreds of thousands of independent contractors on North America who are already local. And so we can do it much more efficiently and cheaply than them trying to cover all their own locations. Plus, they also get a third-party objective view when we do it. So those are great.
So when you do this, do you always do it, I don't know, let's say for the 7-Eleven, so to speak, you go into their stores, or do you represent like Doritos and you go in and see if the Dorito bags are properly lined up and properly merchandised in that?
Well, Doritos is a bad example because they're a DSD network and they do their own checking. But I know what you're asking. We mostly do it for the stores. We have done it for some manufacturers. For example, there's a very large vaping manufacturer who's currently under a lot of FDA pressure, or has been under FDA pressure for years, actually. And we go out and we check their retailers, and especially independent convenience stores, to see what they're doing with their products in terms of for their own coverage and legal and commitments to state governments that they have. So we do work like that. So we can work with a manufacturer, and we have. We've worked with a number of manufacturers, and we go check to see, for example, the best example is, sometimes in the phone space where, somebody at Rogers, for example, wants to know when you go into a store, does that person push their product or do they push somebody else's product? Or, on the financing side of things, you get that too. Do people even talk about a credit facility and about their credit card in their company, or they never bring it up? And so we do manufacturer type things, but most typically it's the retailers themselves who are trying to approve or monitor something. And on the software side, of course, we have a customer satisfaction survey platform, Intouch Survey, and it competes from a forms and functionality standpoint in terms of features and functionality, pardon me. It competes with your Medallias and your Qualtrics and those people. In fact, I won an RFP against all the big guys earlier this spring. But we're a small player, obviously, in that space. That's lots of green space there for us, for sure. Forms and checklist automation, that is an Intouch Check is the name of our product. And that competes really with anybody who has a forms and checklist product where you can go and automate things that used to be on paper and Excel. And then we have, I'll skip to the end, we have the event marketing automation, which is a bit of a legacy platform we've had for years. We still use it with some big clients like General Motors. We support them at events like NASCAR and Major League Baseball, places where they're trying to collect leads. And then the business intelligence platform is interesting. We also call it LiaCX. Listen, interpret, and act is what that stands for, customer experience. But really what it does is it ties everything together. And what's cool is is that if you're buying Intouch Survey or if you're buying Intouch Check, you still get all your analytics and reporting and dashboards and custom dashboards. And we have triggers and alerts and notifications and just all kinds of cool functions that you get because Survey ties into IQ, which is our business intelligence suite, LiaCX. Check ties into that same business intelligence suite. They all tie into the same suite. And by the way, this is where it gets really interesting. All of our services tie into it as well. So if you're getting a mystery shop or an audit or anything on our services, your data is funneled into the same platform that customer surveys and forms and checklists are funneled. The same hierarchy management, the same capabilities to do analytics and reporting. And why that's interesting is that we're the only ones that have that capability organically at our company in the space in terms of what we built. There's nobody else doing mystery shopping who has those capabilities on the software side. And that's a competitive advantage. And it also allows us to do that. I talked earlier about the mission statement and letting people improve business outcomes, right? Well, let's say you have a bunch of mystery shop data and a bunch of audit data, and then you've got some customer survey data that comes in. Well, now you can figure out, okay, we need to fix the following. We need to focus on washroom cleanliness. We need to focus on whatever it is. Well, you can use Intouch Check, our forms and automation product, to actually push out action steps for people, push out on an automated basis things for your teams to do and focus on, and track inside the system whether or not they did them and whether or not that's improving your results, all inside one ecosystem, right? And that is something that's just a full view of customer experience that frankly, it's very difficult to find anywhere else because it's unique for a services company to have that software edge that we have. And that's where they come together.
Sure. Yeah, so if I'm working for you as a mystery shopper, I go into the store, I do my things, and then I've got an app on my phone where I sort of input it in digitally. That goes onto your platform. And then your survey stuff, is this real online stuff, or is it one of those kiosks that you go give a happy face or?
No. It's none of that happy face or happy or not or hit a button or any of that stuff. These are online QR codes, URLs, through loyalty apps. This is those surveys that you get on your phone every time you go do anything. We have a product that does that, and we do that for a number of our customers. Where we have one customer, we collect more than 1 million surveys a year from their customers through their programs.
And that's all online data you're collecting.
All online data.
Gotcha. So you're really bringing the online data to the offline world and kind of merging them together or correlating them together.
Correct. The way I explain it, even when I'm talking to the retailers, is that, the customer feedback tells you what their expectations are. But you need to do your own data on the online world, not even necessarily the offline world, because even if you're doing, let's say you're doing curbside pickup, or you're doing, even if it's just an online ordering process. Well, we sometimes measure those as well for clients, the web orders and things, because any customer experience should be a certain way, regardless of how it's experienced. And we can measure it no matter what the channel is. We do a lot of offline because there are more locations for offline than when you're ordering on the web. But at the end of the day, it doesn't matter, right? It's all about measuring that. And when we measure that, what we're telling you is how your people are executing against your own internal standards. What the customer survey tells you is how customers feel about their experience in your store. And then when you marry those two, what that allows you to do is figure out, should I be changing my standards, right? Are my standards in line with my customers' expectations for this business? Or are they not? Am I measuring the right things? Are my people focused on the things my customers care about? And that's where it's really cool data.
Makes sense.
And now this slide here, we've talked about a lot already, but basically in terms of who we do, it's location-based industries, right? We do lots of petrol convenience and grocery and restaurants and all these, it's you think about places where there's more than one. Now, if there's one big hotel with lots of needs, of course we work with them. If there's a big call center even, of course we can work with them. But really our advantage, our focus, our niche in terms of where we play really, really well is in these location-based industries. It's where combining those two worlds really come together. If you look pre-pandemic, right, SaaS products had launched. And this, by the way, is the slide that answers your question a little bit with this next couple of slides, Martin. I promised I'd answer. Why was the stock going up, right? Well, our SaaS products have been launched. right? We had done acquisitions recently. We had another one planned. We had strong growth was apparent. The stock, as you mentioned, was trending upward, right? We, in fact, had seen 130% revenue growth in the 5 years before March 2020. We'd increased it every year, right? We were looking at a $25 million year in 2020 when we were sitting in the beginning of March. We had done acquisitions, consistently over time. We'd picked up something here and there, including some early in 2020 and another one on the deck, right? We'd had a history of being able to add organic growth and acquisition growth. And then you look at kind of that just general history, and this is where you can kind of see we'll see at the tail end here, Martin, to answer your question. We started 2014 when I took over at 8.5 million and 45 employees. We invested a lot of money and focus into transforming the business from being a basic services company to being a technology services company that had technology advantages, that had SaaS products that tied in. We spent a lot of time and money. We did that one raise in 2017 to help accelerate, get us over the hump. And we actually started to see it pay off in 2019. We started to see the fruits of our labor, right? We saw almost 30% growth. We had $1.5 million in EBITDA. Our SaaS products were starting to get some traction. And then in early 2020, it was the same pattern. And it looked like we were on track for another great year. And that, by the way, is to answer the question of why the stock was starting to move, because we were starting to get the fruits of our investment that we had made. And of course, we all know what happened in mid-March of 2020, right? We had this little thing called a global pandemic. But despite the global pandemic, we were EBITDA positive. We retained our key employees. We retained all of our client contracts. We completed our acquisition, although be it just this October 1st, we got that done. I call it a 2-year pause in the pandemic, the pandemic pause, right? Early trajectory was looking great, as we just talked about. Then in 2020, we were very quick to respond. I mean, we furloughed half our staff, all of the management, all the board of directors, everybody took pay cuts and forgave income for periods of time. We used every government program we could. And the net of all that, and then of course we wound up issuing RSUs to people to keep them around for another year. And the net of all those things is that we weathered the storm very, very well. We didn't lose any knowledge workers that we didn't want to lose. We didn't lose any knowledge workers, right? Our clients, we only lost one client contract I'm aware of because of the pandemic, and that was because because it was one of those manufacturer ones you're talking about, and the retailers they were selling to went bankrupt. So, tough to go to a store that doesn't exist anymore. But other than that one situation, we haven't lost clients. We've had a really clean run through this situation. And then we had a 2021. We were planning for recovery. We had lots of ideas to go, right? And we stabilized our revenue. We stabilized, both software and services were growing, right? EBITDA was strong the whole time. We did manage to complete that acquisition. So I call it the 2-year pause, but really we're kind of back on track. If you look at this, the Q3 year-to-date highlights that we just put out, we got a 54% gross margin. We got $1 million in EBITDA. We're almost 100% recurring revenue. We have, now this is on the 30th of September. So the day before the acquisition, we had no debt and a current ratio of 2.5. And we were 70% almost in the United States for revenue. So, I don't, considering the businesses we're in, I'm pretty happy with how the 2-year, pandemic pause hit us. And that lets us now start looking forward. Programs are continuing to restart. Any clients that have not come back are starting to or are scheduled to. And significant investments are being made in sales and marketing now, particularly with the C-level group coming in. We have acquisition revenue, which we have not seen a dollar of reported yet because it started October 1st. It started Q4 of this year. And as we announced, it was a $5 million US business that we bought. We have technologies that we're going to leverage. I mentioned we didn't lose any knowledge workers. Well, guess what? While they were working during the pandemic and we weren't as busy, they were still building technology because development doesn't stop or doesn't slow down. You're continuing to build features and functionality and just increasing our technology bit. We remained EBITDA positive. And as I've announced, we expect to surpass our pre-pandemic revenue and trajectory as we look forward. And I put this slide together because, to me, this is really, before the pandemic, I used to tell investors, I used to say, look, I think we're undervalued. I think we have a huge upside potential, and I don't think we have a ton of downside potential. I think we're pretty stable and somewhat bulletproof. And people used to be like, yeah, sure, everyone says that. I think that the pandemic kind of proved that I was telling the truth. I mean, if you think about our client base, they're the people that in April, May, June, 2020, all you were reading in the papers was bankruptcies and closures, right? And restructuring. Our clients are the hardest hit industries in the entire pandemic. And yet, despite that, they came back to us as quickly as they could as they started working towards their new normal, right? They valued the insights we provided. They were loyal customers of Intouch. And the fact that our recurring revenue streams started coming back over time and are continuing to come back and expected to be stronger in 2022 tells you that people weren't using this as an excuse to not do that anymore. Oh, you know what? Yeah, we don't need that anymore. It wasn't really that important. Instead, the outlook has been, hey, you know what? What they were giving us was hugely valuable. And by the way, now that we've got these new customer expectations and there's a new normal in the world, we need this information more than we've ever needed it. And so they've come back and they activated our programs as soon as they can, not delayed it as long as they could, but brought them back as soon as they could, based on their own store openings and cash availability. And I think that just speaks volumes to the value proposition that we actually provide to these people. So you look at the future, right? We've got this software, which is new and evolved, brand new software. It's very modern code. It's very flexible. For example, we got customers who are using it to do their own internal health checks for people coming to the office whether or not they got COVID, right? From the services side, we're not just sitting back and, what do we do if people don't shop in the stores every day anymore, right? Well, we're working. We're doing programs on curbside pickup or delivery or takeout or online order. Right? Anytime there's a customer interaction, we can go measure it. And we've got our services team starting to do those types of programs with customers as well. And then you've got that technology I talked about. I mean, geez, we are heads and shoulders on our services side above anybody else because of how strong our technology is. It is just really strong. And we're adding that now to our, and that's the client-facing technology that they see, that they go, wow, this is better. We're also now embarking on a journey of improving our own operational technology that we use within the industry. I won't get into the secret sauce of it, but the bottom line is we're going to come up with a way to deliver the programs more effectively for our clients and cheaper or more efficiently for us. And we're continuing the technology journey. So value potential, my opinion is we're still being valued as a very slow growth, boring services company. And which I get it. I mean, before 2019, we were growing, but not exciting, right? And if you look at the profits, there wasn't a profit story either because we were bootstrapping. We were reinvesting everything. So if you're going to reinvest everything, what that looks like on paper is inefficiency, right? Because what you see is revenue going up and profits not going up, which looks like you're inefficient. Whereas what we were doing was bootstrapping to change a business. And then, of course, 2019 hit and things started to rock and roll. And then, unfortunately, 2020 kneecapped us for a couple of years. But it hasn't changed the potential or the slope. And we've made that investment into that software technology. We have the additional revenue coming already from the acquisition we just did. And that also comes, as I mentioned, with Lisa and her team and some other senior people. We have a sales and marketing engine now from a pipeline standpoint that we've just never seen before in this company. And it's just fantastic. We're expecting that accelerated growth. So I think there's a huge value potential. I mean, if you take a quick look at comparables, and again, this is based on Q3 numbers, and I'm not going to focus on all these numbers. Obviously, we're very strong financially. There's not very many people I can talk about. I mean, MNTV is the new symbol for Momentum Global, which is SurveyMonkey. XM is now what Qualtrics calls themselves. I used to do Medallia, but they sold for $6.4 billion and went private. And then, of course, there's Pronto Forms, which is a Canadian story, similar but 100% software. But if you look at just look at us standalone, ignore comparables. Just look at us standalone. The multiple of 1.2 times revenue. Keep in mind that that's not even real. It is, but it's not, because that's based on Q3. So that's based on Q3 revenue extrapolated for the year. How I did, because I was fair for everybody. So everybody's Q3 extrapolated for the year. But it also is today's stock value. So we've bought a company since then with a whole bunch of revenue that's not factored in to extrapolate it. Like, that's not my predicted revenue for the year. That's just extrapolated number. And these are US dollars, by the way, because that's what everybody else is reporting in. But, that's just extrapolated. That's not where I think I'm going to wind up, because I bought something, but that's extrapolated, and yet I'm only 1.2 times revenue, right? Which means that if you actually took revenue that we've announced we bought and things, that's less than 1 times revenue we're trading at, which I think is a pretty low multiple by most standards. So, I always challenge people to capitalize on the opportunity. Customer experience measurement management, it's not going away. This is something customers need. It's not going by the way of the dodo bird. It's not being pushed out because of technology. It doesn't. People still buy and sell things, and that has always got interaction. That's always got experience to it. And we're seeing that. We've seen the proof of how sticky it is in the last couple of years. We have that loyal customer base, right? We've got technology that positions us to win. That combining of software and services is 100%, an advantage for us in terms of how we're going to stay sticky and grow and cross-sell and upsell. And of course, we've got that recurring business model, right? For SaaS growth and everything else. So with that, Martin, I'll see what you've got questions or people have questions, but that's my slides.
All right. Before you did your software development, were you essentially just sort of a mystery shopping kind of company? Like you send people out, I presume they're independent contractors, and you give them whatever dollars an hour or per visit and so forth. Was that essentially your business sort of software development?
Yeah, before 2014, we really had two business lines effectively. We had mystery shopping, and the services side there. And we also had the event marketing automation. Actually, business was a larger business back in the kind of pre-me at the end of the earlier 2000s, kind of mid-late 2000s, actually in early teens was we had that Intouch Capture, as we call it, but it's the event marketing automation business. And that's a business today. It's still substantial. It's a 7-figure business for us. We got some big logos that use it, but it's not something we've been investing in from a future standpoint, because live events are something that you have to transform. So we've been moving that product away from live event focused and to virtual events and QR codes and websites and those types of things. But we have not been investing heavily into that market. We went instead into the customer experience adjacent markets to what we already do with mystery shopping and build software. So, but there's really mystery shopping and event marketing automation was a little bigger before 2014.
So really, your business has shifted from really a traditional old school kind of services business to much more of an online sort of 21st century kind of model. But I guess the market really hasn't quite noticed, as you seem like, given those multiples, I would ballpark it saying that's kind of what sort of a mystery shopping kind of business would get. And you're getting 50% margin, so it's hardly a low margin opportunity right now.
Yeah, 100%. I mean, look, and again, I get it. I don't think people are just all dumb. It's if you just but people look at the math, right? And if you look at the math, it's like, oh well, they're growing, but it's not. How exciting is it as a growth story? Oh look, they don't seem to make a lot of money, and when they grow, they seem to spend it, and I get all that, right? So I get where people are coming from, but that's why it's such a great opportunity right now, because if you take a look at it and go, oh geez, okay, yeah, they've been spending all their money, but they've been investing in a software company. They've been bootstrapping technology, underneath this old services business. And by the way, we call it old, but that old services, that ain't going away. And that's going to continue to produce a lot of revenue and results for us. But we're using technology to increase our margins, to supplement revenue with those customers, and to make sure we are really sticky, because we can do things that nobody else knows that business can do. And so, yeah, we've definitely modernized. We're modernizing that industry basically, in terms of relative to our competitors. We're kind of modernizing the industry. We don't think it's going to go by the way the dodo bird, because we think checking physical locations is going to be a thing for many decades to come. But we're modernizing it, and it costs money to modernize it. And so, in that journey, I don't think it's been recognized the potential yet. I think that we'll get there. I think for sure, but I don't think we're there yet.
Well, I would think, given the part of my premise is that given the importance of the online world in these retail location retailers, is they're getting better understanding. Hey, we need data. They're getting, because before retailers didn't really have a lot of data. They had some sales stuff. Now they're like, hey, we got to know more about the competition. It's our physical locations that we can maybe compete with against Amazon, so they don't crush us. And so I would think it's becoming more important for the location retailers that they get data.
Yeah, it's funny, Martin. You're right, but there's another layer to it, and that is that they almost have too much data now. They used to have not enough data, and then retailers were like, now we've got all this data, and everyone's trying to show them more data, and there's social media, and there's customer, and there's operational, and there's all this information. And that's one of the places we help, is we actually our platform can distill some of the data down into common elements and say, yeah, you know what? Here's the information there's lots of information available, but here's key information, right? Especially when we go out to stores and physically check, that's accurate, and then we can say, here's a distilled set of data that you should look at. And here's what it's telling you. Oh, and by the way, we have tooling to help you take action on it. For example, something really simple, but let's say somebody's out at a licensee or franchisee somewhere and your signage is graffitied over and broken. Right. Well, somebody can enter into our app that they can just simply put that in as the question answer, like, was the signage in good repair condition? No, graffiti broken. And the fact that happened, our system can automatically, like in real time, can send a notification to the sign company to have that fixed without any intervention by anyone in the company. So, like we've literally created tools to help them fix their problems. And identify them, to distill that data into actionable items, and then go take action on it instead of just being stuck in analysis paralysis by just too much information. So yeah, there's that whole extra layer now of getting to the right data, not just data.
And how much have those perceptions by your customers and potential customers changed sort of pre and post pandemic? Has it changed or just evolved a little bit, or can you talk about that?
That's a great question. I would say that pre-pandemic, people were a little complacent in some of the bigger companies. Sometimes they might have been doing it for long. I mean, they still use the data, they did stuff, but maybe they're a little more complacent about it. Since the pandemic, people are now looking at the data really closely, because they really want to know, are people comfortable in my stores? Are they coming back? What's their, are we hitting these standards? Are we doing that? Because it's more and more, like you say, there's online retail options. It's, do I even leave my house and go out to do things? And then also, of course, we've had that shift to, we'll do curbside and online too, but let's make sure we're doing that right. Because if you get that wrong, well, they might go use somebody else's curbside if they want a curbside and yours was terrible, right? If they don't want to go into a store. So there's a whole new layer of complexity for just the omni-channel world that's come in. And so now our customers, they have to pay a little closer attention to the data, and maybe what we've seen is a little more frequent changes to the programs to keep up with what's going on. So instead of just running the same thing because it's recurring every month, right? And so they can run that sometimes for years without a change. Now we're seeing that not every few months, maybe we're making a change to this or change to that, just to make sure we're keeping up and catching up with what the consumers are looking at.
Sorry, I had mute on. All of your potential customers, are all of them using a service like your own? And when you try to get new business, you have to steal it from someone else, or there's still a large or a significant portion of the market where they're just not using anyone and sort of greenfield expansion opportunities for you?
It's funny. If you took the last 40 years, you'd probably say there's no greenfield opportunity, because at some point everybody had something like that, right? But there's been ebbs and flows, and there's times when people say, oh, I don't need mystery shop, or I don't need that kind of third-party situation, because I'll just use my customer service data. And so big, massive change will just stop doing it. And then what happens is, years go by and they see that their standards execution have dropped, and they see that they've actually not doing as well as a result. And then it'll become back in fashion, and they'll roll back in with programs. And we're actually seeing right now, there's a couple of big RFPs we're working on right now with a couple of major QSR chains who are in those boats. They didn't have
QSR, quick service restaurants?
Quick service restaurants, yeah. A couple of major North American chains, and they don't have a program because they'd stopped it at one point in history. And now with everything going on, they're like, you know what, we should probably get this restarted to understand how customers are interacting and how our standards are. And so you see ebbs and flows, but there's always customers out there to find who don't have a program, number one. Number two, yes, lots of times under competition. And we do not mind competition in any way, because I mentioned earlier, we have things no one else has. We can do things no one else can do. And so when we're inside our verticals, we love competition. Give us a shot at that business. I'd love to take on your incumbent. right? And then there are also opportunities which are kind of reactivations of things like where people, I think I mentioned people are not doing anything. You got people doing something, and then you got this weird third thing where somebody's doing something, but they're doing it with internal resources, which can be very expensive. And so that's another opportunity the pandemic has provided, where some companies where they were trying to do their own third audits of all of their locations on a regular basis, and they're now comparing the cost of that between company cars and travel and salary and everything else. They start comparing that to, well, what would a third party be able to do? And can we save a bunch of money? In all these industries right now, we're looking to save some money. So it's actually kind of all three areas that we could play in terms of looking.
Right. When I'm presuming you don't have hundreds or thousands of employees. You have independent contractors, and you pay them $20 or whatever to go into a store and fill out some survey, depending on the complexity and so forth. What are your kind of rough gross margins on that side of the business versus your more digital service offerings?
Yeah, I mean, our digital offerings are in line with typical SaaS type products. They're running 85 to 90% margins, depending, what on the deal or which product at the time. Whereas our other services, could be on the low end, we could be in the mid 30s. On the high end, we could be up in the 60s. In the product lines. There's a big gap because we do some things. For example, we do some regulatory audits, which are lower on the margin side typically, and they are, for example, pharmaceutical reps. If you're a drug carrying pharmaceutical rep, like we work with Johnson & Johnson, or Janssen is their pharmaceutical side. We work with Takeda, we work with Bristol Myers Squibb, GlaxoSmithKline, names you've heard of, Bosch. And we go, and if their reps are carrying drugs, that means they have samples in their car or in their house or in a storage locker. We actually send people out to go and count those samples, inventory them, check the expiry dates, check the lot numbers, and make sure that everything's accounted for, because it's under FDA regulations. And so we actually go and do very detailed type of things like that, which are great, stable business, and it's certainly a decent amount of income. But we also comes at a higher cost because that auditor has quite a bit of skill and knowledge. So you're hiring higher knowledge workers, so that comes at a little lower margin. Sometimes. So it does vary in that range. And that's why we net out it. And I think our services business in general is in the high 40s, and our software is obviously, much higher.
I want to talk about the acquisition you guys completed recently. Could you just, what kind of business did you buy, and why did you buy it? Was it just for revenues? You can add synergies to it. They gave you a new client base. Talk about that a bit.
Well, why not? Honestly, I'm excited about this one. It's $5 million US in revenue. So I like, standalone, I like that.
Yeah. And that's profitable revenue.
Yeah. I mean, they were, were they running very profitable? I'm not going to. Obviously, they couldn't have been that great, or they probably would have just grown themselves to 10 million. But under with our abilities and technologies and economies of scale, it becomes a different business overnight. And so it's obviously 5 million in profitable business, but we're going to take it a little higher than what they had it from a level standpoint. And it's also customers that are synergistic. Like, they're in the restaurant space heavily. They're in the automotive space. They're in spaces that we are already comfortable and play in, and they had some big logos that we could bring in. At the same time, they had a team of people that had some excellent experience. Lisa, of course, built the company. They have another person who's now working on our sales side, who has decades of experience, and they bought and sold a mystery shopping company in their career. We have an operations person with just incredible experience that has come in, that runs their programs. So we brought some knowledge, and particularly engines around the sales and marketing side of things that are very exciting. That they're not just, we're not just buying revenue and customers and everybody else is gone, right? This is, we're picking up some more cylinders to our engine with this acquisition in terms of our own growth. We pick up their customers who we can now sell software and other things to. Once we get them, we have to get them into our platform, then we can sell them more things, right? They're synergistic. They were culturally relevant to us. They're a people first company. They treat their customers, they treat their employees well. They have a loyal customer base, and so in fact, it only makes sense to buy companies that have a loyal customer base, because otherwise, just go take their customers. But this brought a lot of really cool things in. We're excited about this one.
Right. And so that acquisition closed October 1st. So basically you've got a December year end, right? And
Correct.
So your Q4 is going to be the new sort of entity involved. Like that'll be a full quarter of the new business.
Yeah, and honestly, there's more seasonality to their business we just bought than we have, but so it won't be you'll probably won't see the full impact till you get a little farther into next year, especially with obviously there's always more costs in the first few months when you buy something too, as you get the synergies, and you've got it takes you a while to get things figured out in terms of getting your cost structures under control a little bit, but it's not we're expecting it to be a lift in sales in Q4. We're expecting to push out EBITDA in Q4, despite the one-time increase in costs and everything else. So yeah, no, and none of that's shown up yet in terms of anything in the market, right? I mean, we've announced it, but it's not going to show up until we push out the full year, and then Q1 and go forward 2022, you'll start to see the real impact.
You mentioned before, and I forget the number, what is your split between Canadian business and US business?
60 as of Q3, it was 69% American.
Okay. So it sounds like given whatever, roughly the US is 10 times bigger than Canada, like that's you've got relative market share to gain in the US market, given that.
Oh, yeah, 100%. We are nowhere nearly, I mean, we should be 90% American, right? Now this acquisition will start to put us up there as well, but there is so much business in the United States, to go get. And that's the other thing about having an American sales team as well. Doesn't hurt. But yeah, there's so much business in America.
Are most of your retailers that you work with, are they kind of big national chains? Whenever because the US is so big, and it's less, I think the retail space is less consolidated than in Canada. You go into an area, and here's, like, I used to work in sort of the CPG grocery world, and you'd see in Idaho, here is a 20-store chain that you've never heard of, but they're kind of big in that region. Do you work with those kind of small, medium-sized regional brands, or is it just the big national, like the Safeways and Costco's, so to speak, of the world?
We do both. We do more of the larger national, but even, for example, one of our good customers is Wawa. They are a regional brand, but they're not. They're they got like 1,000 locations. They're one of the like, and they're expanding into other states all the time. So but they're out of Pennsylvania, and then they expanded to Florida. Now, so and so you get these. It's funny because these regional players in the U.S. are often larger than the Canadian national players. Yeah. And so, we don't do a lot of 20-store chains in the U.S. as the example, but we do lots of regional business in industrial business, because regional business in the U.S. is phenomenal with some of these chains. So yeah, we play anywhere. Really, for us, it's about having a lot of locations to go visit, and whether that's a bunch in one location, that's great. If they're spread out across, North America, that's great. We even have clients where we do it on both sides of the border. They have Canadian locations and American locations, and we work on both sides of the border. So we kind of cover the gambit as it relates to that. For us, it's not about whether you're national or regional or how big your brand name is. It's how many locations do you have, because the bigger you are that way, the more worthwhile, we can make our programs for you. So it's, yeah.
I think we've kind of hit the highlights and main points. Is there anything we've missed here that you want to bring up before we start wrapping this up?
No, I think we've hit the stuff. I mean, I put in the presentation, we got through all that, so I think it's fine. Like I say, I totally get why our stock trades as low as it does at 72 cents there. I get why it's so low. It's there hasn't been that story, but I always tell people I'm talking to, I say, but you have to decide when you want to jump into the story. Do you want to wait till everybody else knows about it and it's on its way up, and then you start buying into it, or do you want to buy and hold for a while? But we're also not a pump and up, as you mentioned earlier. We have no intention of creating just a story so people can sell shares. Our plan has been and is going to be to make sure that we are creating more value than we are capturing more value. So, there's an equation out there where some companies are trading at X, but they're not worth X yet. That's a speculative X. We've never been on that side of it. We're on the side of, we're probably worth X, but we're not trading at X. And we keep adding that value to X because we know that if we create the value, we will be able to go get that value. If it's real, we will be able to get it. But we don't want to be on the upside down part of that equation, chasing our own value. And so that's the fine balance. And we went for the whole pandemic, we went purely operational in terms of focus. Now, of course, we're starting to be a little more talking to investors and get the story out there a little bit more now, just because the pandemic is starting to look in the rearview mirror. But that whole time in the pandemic and even today, we are focused on adding value to X.
And for investors, what kind of news flow should people expect over the next 3 to 6 months? Is it just like quarterly earnings, or is there other kind of some catalysts, sort of big contract wins, or what kind of sort of interim news could one expect, just so you get a bit of a pulse of how you guys are doing?
We tend to not announce big contracts typically unless they're material, in terms of changing things. So, obviously you'll get the regular earnings. It's going to come out and that news flow. We're heading into the big gap right now, right? Because the next one doesn't come out till end of March, early April when you get the year end. It's the audited one. So we're heading into the gap period, and then it'll be kind of fast and furious for a few months there on news. So for the next little while, it'll really depend if something large enough comes out that we feel is material enough that we should be announcing it, which may happen. Obviously, I can't tell you if I think that'll happen or not right now, because that's called selective disclosure. But we would announce something if it was material enough. Otherwise, it's probably expect business as usual. We're heading into that long stretch right now, which is boring for people, and then the pace will pick up in the spring. Because Q1 follows year end pretty quickly. But we'll see. Hopefully, great things happen. You hear from us sooner.
You mentioned seasonality before. Is Q4 is like the big quarter for retailers? Do they use you a lot in that quarter, or are they too distracted with selling stuff to actually send guys into the store to poke around?
Yeah, that's exactly right. Q4, ironically, is the busiest time for our customers, and therefore typically our slowest time. Because it's when they want. It's when they want to. When they they're focused on executing all the things that they learned, and they're still running things, but not to the same level. The Q4 is a little bit of a pullback from some of our people. They run their programs, but maybe a little less frequency. So they keep getting data points, but they're really focused on executing all the stuff they learned anyways, because this is the flat out time for them. And then then they get to take a breath and start over in the new year. So Q4 is seasonality. If you look over history, Q4 is usually a little bit lighter for us than the other quarters. Not dramatically, of course. It's all monthly programs, but there's just a little pullback on frequency from some people here and there.
But for this fourth quarter, you're going to also have
right.
a new quarter of your acquired business,
which will be an offset. So therefore, Q4 will likely be our highest quarter this year, but that's because of an acquisition.
Yeah,
because of the offset.
Cam, that's great. Thank you very much for taking the time to tell this story and answer the questions and so forth. Thank you very much, and have a great day.
Thanks for having me. Bye, Mark.